Carlsberg's potential takeover of Britvic becomes more likely. Welcome to Market Insight, I'm Thomas Warner. Let's get the latest on Carlsberg's bid for the UK's Britvic. It's looking like the soft drinks maker may be a more attractive prospect for the Danish brewer. Britvic has 16 years left to run on a deal to bottle a range of PepsiCo products here in the UK. PepsiCo did have the option to end that agreement in the event that Britvic were taken over, but Carlsberg says it has reached an agreement with PepsiCo to continue the deal. Britvic's already rejected a $3.9 billion offer, but many analysts expect it to table another bid within days. To examine this potential deal, I'm joined by independent equities analyst Anna McDonald. Anna, very nice to see you. Thank you very much for your time today. I'm going to start by asking you what the motivation is for Carlsberg's interest in Britvic.
Carlsberg, alongside some of the other big brewers, are finding that beer isn't a tremendously high growth area anymore. So they're looking to expand into other areas. And Carlsberg is very much predominantly a beer business. So buying into ciders or seltzers or into Britvic's non-alcoholic products has been appealing to them.
Is it access to any particular market or region that you think Carlsberg are particularly excited about with this one, Anna, or is it just the overall opportunity?
Well, their UK business is quite stable. It grows mid-single digits revenues and has pretty good margins. But the areas of a bit more excitement for them are particularly Brazil, where they have got strongly growing revenues and volumes as well. Volumes up 22% in the last reporting period. So that kind of growth is attractive to them, and they're developing some new products too, whether it's various kinds of alternative milk products and things like that. So yes, it does have that, and there also could be some synergies because Carlsberg themselves have some bottling that they do for Pepsi, and there are some countries where they could perhaps negotiate better terms, and some other overlap in various areas where they could make some level of synergies.
Let's return our focus to the UK now, Anna. The valuation of UK equities do seem quite cheap compared with their international counterparts. Why do you think that's the case?
Oh, I think it's been quite a long-running saga of lots of pension funds and others in the UK actually de-emphasising the share of UK equities for their clients, and that has meant that they've been investing more overseas and selling down their equity holdings. Additionally, we've had, if you think about the time of we've had Brexit in 2016, which led to some instability. Then we have had COVID, where there were lots of the when interest rates were really rock bottom, and there were lots of tech companies being really exciting the market. A lot of those were in the US, and some of the other successful names that might have been in Europe, such as the luxury goods names that were doing very well during COVID, or L'Oreal and others, they were very popular. So the UK market, with its quite big weightings to oil and gas and mining and so on, they just they were less exciting and less interesting to investors. And we also had within that further volatility caused by Liz Truss and that episode. So that has led to just a general lack of enthusiasm, people selling down, some disappointing performance by recent companies that came to the market in the early 2020s. So that has continued to weigh on the stock market. Clearly, companies are starting to look at the market, and so are investors generally. And we've seen quite a lot of companies being bought or being approached, such as Britvic, but several others as well, whether it's been by private equity or other companies overseas, seeing some real attraction in the UK market.
And of course, fast fashion retailer Shein also seeing an opportunity in London, supposedly looking to launch on the stock exchange here. But apparently it is looking like Beijing is getting cold feet about the listing. What's your take on that? And how disappointing do you think that would be for LSEG?
Well, it's interesting, this one. We're clearly, Shein was hoping to first list in the US, and I think there was political pressure from both the US and from the Chinese that wasn't going to happen. Then we heard that they might be considering a London listing. This would be big for the stock market. This is a £50 billion potential market capitalization. It would be one of the tops, the biggest stocks listed, one of the biggest stocks listed in the market. But we are hearing that the British Fashion Council are raising queries about this, and other bodies, and actually just quite a lot of press. It's not just about being the sort of sloppy seconds that New York didn't want. I think there are genuine concerns about fast fashion, and even though Shein has been very robust in refuting any kind of allegations about its supply chain, there are just those concerns. I suspect, though, that there's actually the influence of China too here, because there is now a thought that Beijing might be putting pressure on Shein to list instead in Hong Kong.
Independent equity analyst Anna McDonald, many thanks for your thoughts. That is Market Insight. Don't forget you can watch more videos on Reuters.com.